Trump economy shakeup, new tariffs, job crisis, BLS firing. Economic Analysis 2025. A tumultuous week for the Trump economy unfolded, marked by new tariffs, troubling job statistics, and a notable dismissal. Tariffs are tightening their grip on both businesses and consumers, while simultaneously generating billions for the U.S. government. The job market is exhibiting significant signs of distress, even though the unemployment rate appears stable. Meanwhile, tech stocks are soaring on Wall Street, driven by the surge in artificial intelligence, while many other sectors are struggling. As Commerce Secretary Howard Lutnick remarked on social media earlier this week, the Trump economy has officially arrived. The week was already set to be eventful, with investors and analysts eagerly awaiting updates on economic growth, employment figures, and the Federal Reserve's latest interest rate decision. Major corporations such as Apple, Amazon, Meta, and Microsoft released their financial results, and Trump had set a deadline for trade agreements for Friday. However, the events of the week exceeded all expectations. Mark Zandi, the chief economist at Moody's Analytics, expressed concern, stating, "I'm sending off red flares. We're on the precipice of a recession. If tariffs keep increasing, I don't know how we avoid a recession." Despite the growing uncertainty and worries about slowing growth, the U.S. economy had been generally viewed as stable leading into this week. The week began in Scotland with the announcement of a trade agreement with the European Union, establishing tariffs at 15%, which ended months of uncertainty regarding the U.S.'s largest trading partner. Subsequent trade discussions took place in Sweden, where U.S. and Chinese officials engaged in 2 days of negotiations. Unfortunately, these talks did not result in a new deal or an extension of the existing trade truce, which is set to expire on August 12th. Treasury Secretary Scott Bessent described the meetings as very constructive, but noted that a formal agreement had not yet been reached. Given the significance of trade relations between the two largest economies in the world, the lack of resolution meant that the uncertainty surrounding Trump's tariff strategy continued, despite some agreements being made with other key trading partners, including the European Union and Japan. Tuesday brought little cause for optimism, as UPS, the international shipping giant, once again refrained from providing financial forecasts for the remainder of the year. This decision raised investor concerns about the implications of Trump's evolving trade war, leading to a decline in the company's stock prices. On Wednesday, the Commerce Department released its report on the second quarter gross domestic product, GDP, which measures economic growth in the U.S. The data revealed an annual increase of 3%, surpassing expectations. However, the same report also highlighted troubling signs regarding business investment, even as inflation was on the rise. Later that day, the Federal Reserve announced it would maintain its benchmark interest rate, partly due to inflation concerns. This decision drew criticism from Trump, who has been pressuring Fed Chair Jerome Powell to lower the key lending rate. In his comments following the announcement, Powell acknowledged ongoing worries about the potential for Trump's tariffs to increase consumer prices, but he also referred to the job market as solid. Notably, 2 members of the rate-setting board, both appointed by Trump, dissented, marking the first such occurrence in over 30 years. Strong earnings reports from Microsoft and Meta, 2 companies at the forefront of the AI investment boom, which is a crucial aspect of Trump's domestic agenda, propelled the stock market to new heights early Thursday. Microsoft briefly achieved a market valuation exceeding $4 trillion. However, by the end of the trading day, stocks had reversed their gains after Trump sent letters to over a dozen pharmaceutical companies, demanding they provide U.S. customers with more competitive pricing for new medications, giving them a 60-day deadline to comply. Later that evening, Trump announced a sweeping new set of tariffs that imposed higher import taxes on various trading partners, including allies like Canada and Taiwan. The new effective rate of over 15% shocked global markets. The month concluded with the Treasury Department reporting record monthly tariff collections exceeding $29 billion. In an interview with NBC News that evening, Trump praised the expansive new tariffs, asserting that everything was going very well, very smooth, while remaining open to new agreements. Then came Friday's jobs report. At 8:30 a.m., the Bureau of Labor Statistics released revisions indicating significantly lower job totals for May and June than previously reported, revealing that the economy added only 73,000 jobs in July, far below expectations. Overall, this suggested that the U.S. had gained an average of just 35,000 jobs per month over the past 3 months. Excluding the increases in the healthcare sector, the U.S. had actually lost more jobs than it created. Despite this, the unemployment rate held steady at 4.2%, indicating that overall joblessness remains relatively low. However, many economists pointed out that this figure is largely due to the president's immigration policies, which are reducing the overall labor force. The White House celebrated the decline in foreign-born workers while also noting a more sustained increase in the labor force among native-born individuals. White House Chief Economic Advisor Stephen Miran stated, "If we're swapping out foreign-born job holders for American-born job holders, I think that's a win." He expressed optimism about the economy's future, citing Trump's trade agreements and tax cuts as reasons for potential improvement. However, the public's perception of a weakening labor market prompted an unprecedented reaction from Trump. Shortly after 2 p.m. Eastern Time on Friday, he announced his intention to dismiss the head of the Bureau of Labor Statistics, citing alleged errors in the jobs data and accusing the agency of manipulating the numbers ahead of the 2024 election. These claims have not been substantiated. This decision sent shockwaves through Washington, with some experts warning that it could lead the U.S. down a path toward authoritarianism. Max Stier, CEO of the Nonpartisan Partnership for Public Service, stated, "President Trump is once again destroying the credibility of our government by firing expert and nonpartisan officials because he does not like the facts that they present. Governments that go down this path find themselves in ugly territory very quickly. It remains unclear whether the outgoing BLS Commissioner Erica McIntyre, a Biden administration appointee, will challenge her dismissal in court. Additionally, Trump will have the opportunity to nominate a new head for the Critical Data Agency and a new member for the Fed's rate-setting board, following the unexpected resignation of Adriana Kugler, another Biden appointee, late Friday. Both nominees will require Senate confirmation, which is currently narrowly controlled by the GOP. When asked if the White House still had concerns about the economy's trajectory, spokesman Kush Desai provided the following statement. In his first term, President Trump used an America First economic agenda to deliver historic working-class prosperity and the first reduction in wealth and income inequality in decades. In his second term, President Trump is implementing the same policy mix of deregulation, fairer trade, and pro-growth tax cuts on an even larger scale. As these policies take effect, the best is yet to come. However, this perspective is not universally shared among economists. Greg Dacko, chief economist at EY Parthenon, expressed his concerns, stating, "All of this is troubling. A weakening economy, slowing labor market, rising inflation, rising tariffs, political influence on a statistical agency, more political influence on the Fed, tensions with Russia, and the onset of a market correction. Trump's economic fiasco, the good, the mad, and the ugly of U.S. economy. The good, the bad, and the ugly, analyzing the U.S. economy's performance under Trump through visual data." In the eyes of Donald Trump's administration, the narrative is clear. The U.S. economy is thriving, inflation is under control, and job opportunities are on the rise. However, a recent influx of economic reports has cast doubt on these optimistic assertions, revealing a more complex reality. This week's economic data regarding Trump's initial tenure presents a mixed bag. Some aspects are promising, while others are troubling and even alarming. The job statistics were so disappointing that Trump resorted to his infamous catchphrase from his reality TV days, "You're fired." The overall economic landscape appears chaotic, characterized by strong headline growth in the largest economy globally, erratic fluctuations in trade, and a significant slowdown in the job market. For the past 6 months, Trump has embarked on an ambitious campaign aimed at reshaping the global economy. He has sought to extract concessions from both allies and adversaries by imposing hefty tariffs on their exports to the U.S. However, the unpredictable and erratic implementation of this strategy has led to some unexpected and bizarre outcomes. Growth, a mixed bag. At first glance, the recent wave of data brought some good news. The U.S. economy returned to growth in the second quarter, with the gross domestic product, GDP, a comprehensive indicator of economic health, expanding at a rate not witnessed since the previous summer. Yet, this positive development followed an unexpected contraction in the first quarter and highlighted concerning figures such as a staggering 15.6% decline in private domestic investment. Businesses have been struggling to adapt to the rapid and unpredictable shifts in sweeping economic policies. While the last quarter showed promising growth, the overall performance in the first half of the year was lackluster, with the economy growing at a mere 1.2%. The Wall Street Journal even labeled it the weirdest GDP report ever. Imports, a roller coaster ride. Digging deeper reveals that the U.S. economy is contending with a series of extraordinary forces as Trump navigates his trade strategy. During the first quarter, companies were largely in a holding pattern, awaiting the president's announcement regarding tariffs, which nations would be affected, the rates imposed, and the timeline for implementation. This uncertainty led to a massive stockpiling of goods, resulting in an unprecedented surge in imports that ultimately pushed growth into negative territory. However, in the second quarter, as Trump intensified his economic measures, imports plummeted at an equally remarkable rate. This shift in net exports, where a country exports more than it imports, contributed positively to GDP. Interest rates, stagnation. This particular chart is likely Trump's least favorite. Despite his numerous public demands, threats, and criticisms, the Federal Reserve has yet to lower interest rates this year. Why is this the case? Jerome Powell, the chair of the central bank, has consistently argued for a cautious approach, suggesting that the Fed should wait to assess the impact of the president's trade policies before making any moves. Fed officials are concerned that inflation, contrary to Trump's assertions that it has significantly decreased, has remained stubbornly high and could potentially rise due to the tariffs imposed. This situation has not been well received in the White House, where officials are eagerly counting down the weeks until Powell's term as chair concludes next May. Until this point, many within the Federal Reserve believed that everything was progressing smoothly, and officials from the Trump administration claimed they were overseeing a booming economic environment. However, the employment report for July revealed that far fewer jobs were created than economists had anticipated, with revisions for May and June showing a shocking downward adjustment of 258,000 jobs. Job creation has effectively stalled. This jobs report isn't ideal, acknowledged Stephen Mirren, chairman of the White House Council of Economic Advisors, during an interview with CNN. He suggested that as uncertainty surrounding trade and fiscal policy diminishes, significant improvements would follow. Things are going to get much, much better from here, he confidently asserted. What do you think? Is the economy truly on the upswing, or are we merely witnessing a facade? Share your thoughts in the comments below. And here's where it gets controversial. Are the economic strategies being implemented sustainable in the long run, or are they setting us up for future challenges? Engage with us and let's discuss. Understanding the U.S. economy, inflation, trade, Fed jobs. Feeling overwhelmed by the economic headlines? You're not alone. The U.S. economy is a complex puzzle of numbers, policies, and global forces, and recent developments have left many scratching their heads. But here's the thing. The pieces are starting to fall into place, though not without controversy. Let's break it down, step by step, and uncover what's really happening beneath the surface. And this is the part most people miss. The real story is, and while President Trump's trade deals promise new markets for American goods, they're also making everyday items cost more. But here's where it gets controversial. Are these tariffs a smart long-term strategy? Or are they sowing the seeds of future inflation? Economists are split, and the public is left wondering if the benefits outweigh the costs. Let's start with the big picture. The U.S. economy has defied expectations this year, staying resilient despite global turbulence. But don't let that fool you. There are cracks forming. The job market, once a rock-solid foundation, is showing signs of strain. Employers are hiring at a slower pace, and industries like healthcare and hospitality are dominating the few gains we're seeing. July's job report was a wake-up call. Hiring was weaker than anticipated, and earlier months were revised downward, painting a grimmer picture than we thought. At just 85,000 new jobs per month, we're barely keeping up with population growth. That's the weakest pace since the Great Recession, excluding the pandemic crash of 2020. And if you're thinking, wait, isn't that normal? Consider this. Even in a healthy economy, this rate is alarmingly close to a tipping point. Now, let's talk tariffs. Trump's aggressive trade agenda has pushed the U.S. into a global tariff war, with the effective tax rate on imports soaring to over 18%, a staggering jump from just 1.2% last year. According to Yale's Budget Lab, this could add $2,400 in costs for the average household. But here's the twist. These tariffs aren't just affecting your grocery bill. They're also reshaping the economy in subtle ways. For instance, June's inflation data showed a 0.3% monthly spike in the PCE price index, the Fed's favorite inflation gauge, pushing the annual rate to 2.6%. That's the highest in 4 months and a troubling sign for the Fed, which aims for 2% inflation. If this trend continues, we could see annual inflation climb past 3%, a level that could erode savings and stifle growth. The Fed is caught in a tough spot. Chair Jerome Powell has kept interest rates high, arguing the economy is strong enough to handle it. But critics, like Trump himself, blame these rates for rising mortgage costs. Here's the catch. The Fed doesn't set mortgage rates directly. That's the bond market. And Trump's policies, from tariffs to his public attacks on Powell, have made bonds less attractive to investors. When demand for bonds drops, yields rise, and so do mortgage rates. So who's really to blame for your higher home loan? The answer isn't as simple as it seems. Now, let's unpack the GDP numbers. The second quarter growth rate hit 3%, a solid figure on paper. But dig deeper, and the story changes. In Q1, the economy shrank. But a surge in inventory stockpiles before tariffs kicked in made it look worse than it was. Then, in Q2, those stockpiles were sold off, making the economy appear stronger than it actually is. It's like comparing a marathon to a sprint. Both are races, but the finish lines aren't the same. So, what's the truth? The economy is slowing, but not collapsing. Consumer spending is rebounding, but it's fragile. Businesses are cautious, and the Fed's tightrope walk between growth and inflation is getting trickier. And here's the part that keeps economists up at night. The job market's weakness is eroding the economy's buffer against shocks. As Gregory Dacko of EY Parthenon put it, this type of very weak job growth momentum is essentially eroding the economy's buffer against headwinds. With global supply chains still recovering from historic disruptions, the U.S. is more vulnerable than ever. A recession isn't guaranteed, but the risks are rising. And that brings us to the million-dollar question. Do you think the benefits of these trade policies outweigh the costs to consumers? Share your thoughts below. Let's start a conversation.